What if the biggest mistake beginners make in investing happens before they ever start? Most new investors walk in with ideas they never consciously chose. These ideas come from family advice, social media, headlines, and repeated opinions that sound sensible. Over time, those beliefs settle in and start guiding decisions without being questioned. That is why investing often feels intimidating at the beginning. It seems risky, complicated, or meant for people who already know more. Those feelings do not come from the market itself. They come from myths that distort how investing actually works. In this video, we will break down the top 5 investment myths that still mislead beginners today. Once you see them clearly, investing starts to feel simpler and more achievable. Let's begin. 1. Investing is risky. Banks are safe. This is one of the most common beliefs beginners carry. Banks feel safe because balances do not move up and down. Numbers only go up. That stability feels comforting. Investing feels different. Prices fluctuate. Markets fall. Headlines talk about crashes. That movement creates fear, so investing gets labeled as dangerous. The truth is more nuanced. Yes, investments can lose value in the short term. That risk is real. But safety is not only about avoiding ups and downs. It is also about protecting your future purchasing power. Money sitting in a bank account usually earns low interest. Over time, inflation quietly reduces what that money can buy. Your balance may grow, but its real value often shrinks. Investing carries short-term risk, but it also offers long-term growth. That growth can help your money keep up with rising costs over time. Risk is not something to avoid completely. It is something to manage. Beginners often misunderstand risk as volatility. Volatility is movement. Real risk is running out of money in the future because growth never happened. Smart investing uses diversification, time, and patience to reduce risk. It is not about gambling. It is about planning for long-term goals like retirement, education, or financial stability. 2. Investing is only for rich people. Many beginners believe investing starts after wealth. They think you need large sums of money before you even begin. That belief keeps people waiting for a future moment that may never arrive. The reality is that investing has become more accessible than ever. You do not need thousands of dollars to start. Many platforms allow small, regular contributions. Some funds allow very low minimums. Investing does not mean buying expensive stocks or trading daily. For many beginners, investing simply means contributing consistently to retirement accounts, education funds, or diversified funds over time. Small amounts, repeated regularly, can grow surprisingly large given enough years. This myth also ignores the power of compounding. Compounding rewards time more than size. Starting early with small contributions often beats starting late with larger ones. Waiting to be rich before investing flips the logic. Investing is one of the tools that helps people build wealth gradually. Beginners who understand to stop waiting for perfection. They focus on consistency instead of size. That shift alone changes outcomes. 3. You need to time the market to succeed. Market timing sounds smart at first. Buy low, sell high, avoid crashes, enter at the perfect moment. It feels like common sense, and it feels like control. That is why this myth traps so many beginners. In real life, timing the market consistently is one of the hardest things to do. Even professional investors with full-time teams struggle to get it right. Beginners usually face a worse outcome. They wait for clarity that never arrives. When markets rise, prices feel too high. When markets fall, fear takes over. So they delay again. This waiting creates a quiet cost. Time passes while money stays on the sidelines. Compounding never starts. Confidence slowly erodes. Many beginners end up watching markets for years without ever building real momentum. Long-term investing works differently. It does not depend on one perfect entry point. It depends on repeated action over time. Investing regularly spreads risk across many market conditions. Some purchases happen at highs. Some happen at lows. Over time, the average smooths out. Studies repeatedly show that investors who invest consistently often outperform those who try to jump in and out. Even investors who start near market peaks and keep investing tend to do better than those who wait in cash for the right moment. The reason is simple. Markets reward patience more than prediction. This does not mean timing never matters at all. It means beginners should not let timing anxiety stop them from starting. A simple, disciplined approach removes pressure. You do not need to predict tomorrow. You only need to stay consistent over years. Beginners who believe this myth stare at charts. Beginners who move past it build habits. And habits quietly outperform guesses. 4. It is always a good time for everyone to invest. You often hear one simple message. Start investing as early as possible. While the intention behind this advice is good, it leaves out an important truth. Investing does not exist on its own. It sits inside your full financial life. Beginners sometimes take this advice too literally. They rush into investing without checking their foundation. They invest while worrying about rent bills or unexpected expenses. Instead of confidence, they feel pressure. Instead of patience, they feel anxiety every time markets move. Short-term stability matters more than many beginners realize. If you do not have emergency savings, every market dip feels dangerous. If high-interest debt keeps growing, investment gains may not even keep up with the cost of that debt. In these situations, investing can create stress instead of progress. This does not mean investing is a mistake. It means timing should match your situation. For some beginners, the right move is to build a small safety buffer first. For others, it makes sense to reduce expensive debt while investing modestly at the same time. Progress does not have to be all or nothing. The real myth is thinking there is one correct timeline for everyone. Financial advice often sounds universal, but real lives are not. Income, expenses, family responsibilities, and job security all matter. Ignoring them creates fragile plans. Good investing supports your life instead of competing with it. When your basics are covered, you can invest with calm and consistency. You stop reacting emotionally to short-term changes. You stay invested longer. Beginners who understand this myth stop comparing themselves to others. They stop feeling late or behind. They focus on building a plan that fits their reality. That flexibility is what makes investing sustainable over the long run. 5. You need a complex strategy to succeed. This myth intimidates beginners more than almost anything else in investing. Charts flash across screens. Indicators stack on top of indicators. Strategies sound technical and exclusive. The message feels clear. If you do not understand all this, you are not ready. That belief stops many people before they even begin. Beginners assume investing requires constant analysis, fast decisions, and deep technical skill. They feel unqualified, so they delay, or they try to copy complex strategies without understanding them, which creates confusion and stress from the start. The truth looks very different. Many long-term investors who succeed do not rely on complicated systems. They focus on basics. They invest regularly. They spread risk across different assets. They hold for long periods. They review occasionally, not daily. Complexity does not automatically improve results. In fact, it often does the opposite. More moving parts mean more chances to make mistakes. More decisions mean more emotional reactions. More attention means more temptation to interfere at the wrong time. Simple strategies work because they're easier to follow. They reduce the urge to react to headlines. They remove the pressure to predict short-term moves. When markets rise or fall, simplicity keeps behavior steady. Beginners do not need perfect strategies. They need strategies they can stick with. Sustainability matters more than sophistication. A plan that feels calm and repeatable beats a complex plan that collapses under stress. Starting simple also creates space to learn. As you invest, you gain experience. You see how markets move. You learn how you react emotionally. That feedback is valuable. Complexity can always be added later if there's a real need. For most people, that moment never comes. Simple, disciplined investing covers the goal. The myth that investing must be complex only creates fear. Clarity removes it. Now let's connect these myths. Believing banks are always safer than investing creates fear. Believing investing is only for the rich delays action. Believing market timing is required causes paralysis. Believing everyone should invest immediately creates stress. Believing complexity is required creates intimidation. Together, these myths keep beginners stuck. The key insight is this: investing is not mysterious or reserved for experts. It is a tool, like any tool. It works best when used with realistic expectations and patience. Let's wrap this up. Beginners struggle not because investing is impossible, but because myths distort reality. Once those myths are cleared, investing becomes calmer, simpler, and more achievable. Progress comes from consistency, not perfection. If this video helped clear some confusion, like it, share it with someone just getting started, and subscribe for more simple, practical investing content. Thanks for watching.